Hello, and welcome back to the channel. I'm Algabot, and today we're taking a close look at an expert advisor for MetaTrader 5 called Drift Significance Trend. This is a trend-following strategy with a statistical twist. Instead of reacting to every price move, it runs a one-sample t-test on recent returns and acts only when the measured drift stands out clearly from ordinary market noise. Over the next few minutes, we'll unpack how the t-statistic works, how a slower moving average keeps signals in line with the broader trend, and how the code turns all of that into trades. Let's get started. So what exactly does Drift Significance Trend do? At its heart, this expert advisor is a trend-following system, but it adds a layer of statistical discipline that most momentum strategies skip. Ordinary momentum systems react to any positive or negative move, which means many of their signals are hard to tell apart from the random wandering of price. Drift Significance Trend takes a different route. It measures whether the recent drift in price is large enough, relative to the noise around it, to be considered statistically meaningful. To do that, the strategy looks at a rolling window of completed bars, by default the last 20, and calculates the log returns of each bar. It then runs a one-sample t-test on those returns. The result is a single number, the t-statistic, which behaves like a signal-to-noise ratio. When the t-statistic is large, the average move is big compared with how scattered the returns are, suggesting the drift is unlikely to be pure chance. When it's small, the moves are probably just noise, and the strategy stands aside. On top of that, a slower moving average, the trend EMA, set to 50 periods by default, acts as a regime filter. A long is only considered when price is trading above that average, and a short only when price is below it. So the short-term signal has to agree with the longer-term direction. Because it works on log returns and a moving average, this approach can be applied to any symbol and any time frame you choose in the tester, from foreign exchange pairs to indices and metals. It's designed with a small number of broadly ranged settings to resist overfitting. This kind of strategy tends to suit traders who are curious about a more measured, statistics-based take on trend following. Remember, this is educational information only and not financial advice. Let's walk through the logic step by step, exactly as the expert advisor runs it. Everything happens once per completed bar, so the strategy makes a decision only when a candle closes, never in the middle of a forming bar. First, the EA gathers the most recent completed bars into a rolling buffer. Using the last 20 of them by default, it computes the log return of each bar. That's the natural logarithm of one close divided by the previous close. This gives a clean series of period-to-period moves. Next, it runs the one-sample t-test on that series. It takes the mean of the returns and divides it by the standard error, which is the standard deviation divided by the square root of the sample size. The output is the t-statistic. A large positive value means price has been drifting upward in a way that stands out from the noise. A large negative value means the drift has been downward and meaningful. A value near zero means the recent moves look essentially random. Now comes the entry condition, and this part is important. The strategy does not act simply because the t-statistic is high. It waits for a fresh significance cross. That means the t-statistic was inside the plus or minus threshold band on the previous bar. The default threshold is 1.5 and has just pushed beyond it on the current bar. When the t-statistic crosses above the positive threshold, that's a long candidate. When it crosses below the negative threshold, that's a short candidate. By requiring a fresh cross, the strategy enters as drift becomes significant, rather than re-entering every single bar it stays elevated. Before any position opens, the regime filter has to agree. For a long, the closing price must be above the slower trend EMA. For a short, the close must be below it. This keeps short window significance aligned with the prevailing longer-term direction and helps filter out whipsaws. The strategy also allows only one open position per magic number at a time, so it won't stack trades on the same signal. Finally, risk management is handled with the average true range. The stop loss is placed at 2 times the ATR away from entry by default, and the take profit at 3 times the ATR. That gives a reward to risk shape of 3-2. If the volatility reading is invalid, the trade is skipped entirely. Let's look at how this reads in MetaEditor. At the top are the input parameters you can adjust in the strategy tester. Lookback, defaulting to 20, sets how many bars of returns feed the t-test. TStatThreshold at 1.5 is the band edge that decides how significant the drift must be. Trend EMA period at 50 defines the regime the signal has to agree with. ATR period at 14 sets the length used for the stop and target distances, while AtrSlMult and AtrTpMult at 2 and 3 scale those distances. Lot sets the fixed position size. Now the signal block. The code computes two booleans. Cross-up is true when the previous t-statistic was at or below the threshold and the current value is above it. Cross-down is true when the previous value was at or above the negative threshold and the current one is below it. It also reads the EMA and the last close to set regime up and regime down. For the long side, when cross-up and regime up are both true, the EA takes the ask price, sets the stop-loss below entry at the ATR-multiple, sets the take-profit above entry, and calls trade.buy with the fixed lot size. For the short side, when cross-down and regime down are both true, it takes the bid price, places the stop above entry, the take-profit below entry, and calls trade.sell. Both sides are symmetric, the same statistical test, and the same regime check, just mirrored. That's the entire decision in a handful of lines. Now let's bring it all together on a chart. On the price panel, you can see the candles along with the blue trend EMA line weaving through them. In the panel below is the drift t-statistic, our signal-to-noise measure, with dashed threshold lines drawn at plus 1.5 and minus 1.5, and a zero line in the middle. When the t-statistic pushes into the green zone above the upper threshold, drift is significantly upward. When it drops into the red zone below the lower threshold, drift is significantly downward. Look at the first few candles on the left. Price is drifting sideways in a tight, choppy range, and notice the t-statistic down below. It's hovering close to the zero line, ducking slightly above and below it. This is exactly the kind of market the strategy is built to ignore. The moves are small relative to their scatter, so statistically they look like noise and no position is taken. Now watch as the next candles begin to step higher. Each close is a little above the last, and the upward drift starts to build. In the subpanel, the t-statistic climbs steadily from near zero, up through 1, and approaches the upper threshold. Price is also lifted above the blue trend EMA, so the regime is now pointing up. On the highlighted candle, two things line up at once. The t-statistic pushes above the plus 1.5 threshold for the first time, a fresh significance cross into the green zone, and price is trading above the trend EMA. That agreement is what produces the buy entry marker you see here. At that moment, the strategy records the entry, places its stop below, roughly 2 ATR away, just under the recent swing low, and sets its take-profit target above, at 3 ATR. From there, price follows through. The next candles extend the move higher with strong bodies, and the t-statistic pushes deeper into the green zone, confirming the drift is holding. Price reaches the take-profit target marker, and the long position closes in this illustration, capturing a move worth 3 units of ATR against the 2 units it was risking. Now the character of the market changes. After the peak, price stalls and rolls over. A taller candle closes lower, and then another, and price slips back below the blue trend EMA. The regime has flipped to the downside. Down in the subpanel, the t-statistic, which had been high, falls back toward zero and keeps going, crossing below the zero line as selling takes over. Watch the next highlighted candle. The t-statistic drops below the minus 1.5 threshold, a fresh significance cross, this time into the red zone, and price is now sitting below the trend EMA. Both conditions for a short agree, and the sell entry marker appears. The strategy mirrors its earlier logic exactly. It places the stop above entry at 2 ATR and the take-profit target below at 3 ATR. Price then works lower, candle by candle, each one closing beneath the last, and the t-statistic sinks further into the red zone. Finally, price reaches the lower take-profit target marker, and the short closes in this example. Notice the symmetry of the whole sequence. The long and the short used the same statistical test, the same fresh cross requirement, and the same regime agreement, simply mirrored. And in both cases, the strategy waited for the drift to become statistically significant before committing, rather than chasing every small wiggle. That patience is the entire idea behind drift significance trend. And that brings us to the end of our look at drift significance trend. We covered how the expert advisor measures drift with a one-sample t-test, how it waits for a fresh significance cross beyond the threshold band, how the slower trend EMA keeps signals aligned with the broader direction, and how the average true range sets the stop and target. We also walked through the code and a full chart example of both a long and a short. Everything in this video is educational information only and is not financial advice, a recommendation, or a solicitation to trade. Trading carries risk, and losses do occur. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like to see next, and subscribe for more MT5 strategy analyses. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.